Good afternoon, and welcome to Bulls, Bears, and the Bell, your essential guide to understanding the true undercurrents of the market. Today, we're plunging into a really paradoxical day in the U.S. stock market, September 10th, 2025. While the headlines might have been blaring about new record highs, the actual story, well, for discerning investors, it was one of profound divergence. A real tale of two texts, you could say. Capital is being allocated with almost surgical precision. We're going to uncover how major indices, soared to these unprecedented levels, but at the same time, others lagged significantly, just fell behind. And this wasn't just random market noise, it was driven by this powerful mix of pivotal macroeconomic shifts and some absolute dramatic company specific news. We're talking an unexpected turn in inflation data that set, well, surprisingly dovish tone for the Fed. Then there's the monumental, almost unbelievable rise of an AI behemoth, added hundreds of billions to its market cap in a single day. And in stark contrast, the equally dramatic fall of a semiconductor giant, just grappling with internal issues, geopolitical headwinds, the works. Our mission today is clear. We're going to extract the most important nuggets of knowledge. We've got market reports, deep dive research, expert analysis. We want to help you understand not just what truly shaped this pivotal day, but why it happened. And crucially, what it all means for your understanding of future market dynamics. You'll walk away with, hopefully, a crystal clear picture of the powerful, often conflicting forces playing out beneath the surface. Okay, let's unpack this. So let's kick things off by immediately confronting that paradox. September 10th. If you just glanced at the top line numbers, you might think, wow, fantastic day across the board. The S&P 500 closed at 6,534.97. That's up, 0.34%, respectable. And the tech-heavy NASDAQ composite, it soared to 21,960.30, gained 0.37%. Both of these benchmarks actually carved out brand new record highs, pushing past previous peaks. On the surface, yeah, it looked like a celebration for the bulls. But as we often find in these deep dives, the headlines rarely tell the whole story, do they?
Not at all. This is a profound study in contrasts, really.
So not a broad, uniform rally then?
Emphatically not. It wasn't a rising tide lifting all boats equally. No way.
So what did the sources say?
What our sources consistently highlighted was capital being allocated with, well, almost surgical precision, as you said, flowing intensely into very specific areas while aggressively exiting others.
Creating that, what are strategists calling it, a barbell market?
Exactly. A barbell market, characterized by extreme winners at one end, fueled by this undeniable conviction, and equally extreme losers at the other end, swiftly punished for any perceived misstep or weakness.
And to really drive that point home, that narrow leadership, look at the Dow Jones Industrial Average. While the NASDAQ S&P 500 were breaking records, the Dow, which is, more traditional industry and finance,
It actually lagged significantly.
right, it fell 310.99 points, or 0.68%, closed at 45,400.35.
That's stark difference.
Yeah.
Two major indices hitting records, a third prominent one declining.
It just perfectly underscores how narrow that day's advance was.
It really shows how selective investor enthusiasm was, focused intensely on certain narratives, almost excluding everything else. And what's truly fascinating here, I think, and a critical insight for anyone navigating these markets, is that this barbell market isn't just a description of price action. It signifies a market operating in a deeply entrenched conviction mode.
Conviction mode. Explain that a bit.
Well, investors weren't just passively reacting to news. They were actively, aggressively chasing a dominant growth theme, specifically AI, the advancements, the future potential. And at the same time, they were showing zero tolerance for any disappointment or perceived weakness anywhere else.
So not just risk on, risk off.
No, it's more nuanced. It's a clear signal the market's willing to pay this extraordinary premium for perceived perfection and future transformative growth, while punishing anything less with surprising, often brutal severity. And this intensity of conviction, it raises an important question, doesn't it?
Like, is this healthy or fragile?
Exactly. Could it be a sign of increased fragility, where any crack in that dominant narrative leads to an equally brutal reversal?
What's your take, based on the sources?
My take, drawing from the material, is that this structure reflects an increasing focus on narratives, thematic investment, not just broad economic cycles alone.
So for the listener, what's the deeper insight?
The deeper insight for you is that diversification in this environment might mean being diversified across narratives and themes, not just traditional assets. It suggests companies without a clear, compelling, forward-looking story, especially one tied to a trend like AI.
They just get left behind.
Likely, yeah. Regardless of their current fundamentals, because capital isn't looking for good enough. It's hunting for transformative potential at the extremes of that barbell.
So navigating isn't about riding a broad tide anymore.
No, it's about identifying those specific pockets of intense conviction and really understanding the narratives driving them.
That's a profound point. Conviction mode and narratives driving things really sets the stage. Okay, now let's shift focus. Let's talk about the primary macroeconomic catalyst, the thing that provided that generally positive, though selective, backdrop for much of the market on the 10th. This came as some truly unexpected and frankly very good news on the inflation front. For market sentiment anyway, we're talking about the August 2025 Producer Price Index, the PPI. This report came out and bam, delivered a significant surprise, rippled through the markets immediately.
Right, the headline PPI measuring wholesale prices, it actually fell 0.1% month over month.
Which was a big deal because July saw that 0.7% increase.
Exactly, a sharp, welcome reversal. And it completely defied the consensus forecast. Economists were broadly expecting a 0.3% rise.
So not just a minor beat, it was a genuine negative surprise, but in a good way for the market.
The best possible way, you can argue.
And it wasn't just the headline number, was it?
No, the core PPI, which strips out food and energy, the volatile stuff, that also declined by 0.1%.
Double confirmation really solidified that narrative of easing price pressures.
Suggesting disinflationary trends were gaining traction, yeah.
And year over year.
Both decelerated notably. Headline PPI down to 2.6%, core PPI cooled to 2.8%. Further reinforcing that idea that inflation was trending down.
Now, explain this. Why was this specific data point such a colossal deal for the market? It's just one report.
Well, this unexpected disinflationary reading was almost immediately interpreted as a green light.
Green light for what?
For the Federal Reserve to finally cut interest rates at its upcoming meeting.
Ah, the magic words, rate cut.
Precisely. And that prospect sent this powerful wave of optimism cascading through rate-sensitive sectors. Growth stocks, real estate, you name it.
Analysts were quick to jump on it.
Oh, yeah. Statements like the data rolled out the red carpet for a Fed rate cut next week, or it gave the central bank the go-ahead to cut.
So for investors waiting for that dovish pivot, this was huge.
Absolutely massive for sentiment.
And we saw that reflected in the probabilities too, right?
Yeah.
The Fed Watch tool.
Instantly quantified. The CME Fed Watch tool, closely watched by traders. It showed the likelihood of a 25 basis point rate cut at the next week's FOMC meeting surged to a staggering 90%.
90%, just based on this one report.
Incredible, isn't it? And traders didn't stop there. They started pricing in the possibility of 3 separate rate cuts before the end of 2025.
Wow, that's a rapid, substantial shift in expectations.
It really underscores just how much markets were yearning for that dovish pivot from the Fed, all predicated on one piece of data. But if we connect this to the bigger picture, the specifics of this PPI decline are actually even more important than the headline number suggests.
Oh, how so?
The primary driver for the fall wasn't a broad drop in goods prices. Those actually edged up slightly, surprisingly. Instead, the overwhelming factor was a 0.2% drop in services prices.
Okay.
And within that, a particularly substantial 1.7% fall in final demand trade services.
Final demand trade services. Remind us what that is.
Basically, it measures the profit margins received by wholesalers and retailers. So when that category falls sharply, like 1.7%, it means businesses in the supply chain are largely absorbing rising costs.
Costs like?
Likely related to the persistent impact of the Trump administration's import tariffs, in this case. They're not passing those costs directly onto consumers.
Ah, so that keeps consumer prices down. Good for inflation now.
Exactly. This margin compression acts as a powerful disinflationary force right now. It prevents consumer prices from rising as much.
But. I sense a but coming.
But. It presents a fascinating kind of nuanced scenario. While it's good news for inflation short term, it simultaneously raises a pretty big red flag.
About future profitability.
Yes. Future profitability and earnings potential for companies across retail and wholesale. It's a classic good news for inflation, potential future bad news for some earnings paradox.
And the market, in its excitement about a rate cut, might be overlooking that.
It might be underestimating it, yes. Because that trade margin compression can't continue indefinitely without hitting corporate bottom lines. It also fits the broader context, doesn't it? A slowing U.S. economy, as Fitch Ratings noted recently. Weak labor market data, too.
All combining to ease fears of persistent inflation.
Right, easing fears the Fed would be forced into a restrictive stance. So in a sense, it frees them up to focus more on supporting growth.
That's a brilliant distinction. The immediate impact versus potential long-term pressure really shows the depth you get from a proper deep dive. But does the market truly appreciate that nuance? Or is it just seeing green light and charging ahead?
That's the million-dollar question, isn't it? I think the immediate reaction suggests a focus on the green light.
Hmm.
But for you, our listener, understanding this shift is crucial. Fed policy affects everything, your mortgage, your investments.
That
This PPI data, seen through that lens of trade margin compression, suggests a potential pivot to more growth-supportive policy. Huge implications. But, as we discussed, digging into the components reveals there's always a subtext, a potential trade-off. Informed investors need to consider that.
That PPI deep dive really highlights the subtle, powerful forces, how one data point can just reshape expectations instantly. But as we established, this market is in conviction mode, highly selective, and that selectivity was about to create a truly historic, almost unbelievable event for a single company, showing just how powerful that AI narrative has become. Prepare yourselves. Here's where it gets really interesting. While the macro news give a broad tailwind, the most dramatic story, a true tsunami of market movement, was undeniably Oracle Corporation, or CL. This one company's performance on September 10th just highlighted the immense, almost gravitational pull of the AI theme, proving its ability to fundamentally re-rate a company in the blink of an eye. Oracle shares surged by an astonishing 41% during the session. 41%.
Incredible number.
It closed up 35.93%. Let that sink in. This wasn't just a good day for Oracle, it was its largest single-day percentage gain since 1992.
1992,
Yeah.
a lifetime ago in tech years.
This explosive move added, an estimated $268 billion to its market cap.
Pushing it right to the brink of $1 trillion.
And here's a mind-boggling stat from Dow Jones market data. First time ever, a company over $500 billion gained more than 25% in one day.
History being made right there.
So massive, it briefly made co-founder Larry Ellison the world's richest person. Just an incredible display of market power, conviction. But here's the kicker, and this is the crucial insight for you. This explosive move was not a reaction to their fiscal Q1 results.
That's the twist, isn't it?
Yeah, their reported revenue and adjusted EPS actually fell slightly short of analyst expectations for the quarter.
Miss expectations, but the stock explodes, so what gives?
Exactly. No, this monumental rally was entirely forward-looking, driven by stunningly aggressive guidance and a powerful narrative shift squarely centered on Oracle's role, its burgeoning role, in the AI ecosystem.
The market looked past the minor current misses, straight into a radically different future.
The bullish thesis, the bedrock behind this unprecedented re-rating. It was built on three key pillars unveiled on their earnings call. First, and maybe the most compelling, massive AI contracts.
Billions of dollars worth, right?
4 multi-billion-dollar cloud contracts announced, and crucially, they disclosed a landmark deal with OpenAI.
OpenAI. The name's synonymous with this AI revolution.
Exactly. This wasn't just another contract. It was powerful third-party validation.
Proving Oracle could provide that specialized high-performance computing needed for the biggest AI models.
It instantly put them on a competitive footing with Amazon, Microsoft, Google, a position few analysts gave them before. Okay, pillar number 2.
Explosive backlog growth.
The remaining performance obligations, or RPO, contracted but not yet recognized revenue.
Surged to an astonishing $455 billion.
$455 billion? That sounds astronomical.
It is. To put it in perspective, that's up from $138 billion the prior quarter.
And compared to others.
Reportedly about 4 times the backlog of Google's cloud division.
Wow. So that's tangible evidence of a vast, durable future revenue stream locked in.
Exactly. Ready to be recognized over the coming years.
And the third pillar.
Aggressive long-term forecasts.
Management provided this exceptionally bullish outlook. Electrified investors.
They projected cloud infrastructure revenue jumps 77% to $18 billion this fiscal year.
77% growth. Impressive.
But they didn't stop there. They forecasted that this segment, the heart of their AI strategy, could grow to an eye-watering $144 billion in revenue by 2030.
By 2030, that fundamentally alters the growth trajectory.
Absolutely. That level of long-range visibility, ambition, backed by real contracts, massive backlog,
Yeah.
it just changed everything for investor sentiment.
The market's reaction really was a fundamental re-rating of Oracle, a complete reimagining of its role. For years in the cloud race, they were seen as a distant competitor, right? Overshadowed by AWS, Azure, Google Cloud.
Their legacy database business was profitable, but seen as slower growth. Exactly. Valued like a more mature enterprise software company. But now, Wall Street sees them as having carved out this defensible, highly lucrative position, a key enabler of the AI revolution.
So investors looked past the slightly lackluster quarter.
and valued the company purely as a high-growth AI infrastructure provider. It's not just a stock moving up, it's a reimagining of the company's identity and future.
Absolutely. A clear vision, a compelling narrative, incredibly powerful for a company Oracle's size. But, expert, for a company that missed current earnings, doesn't this kind of explosive forward-looking rally based on guidance years out, doesn't that introduce a lot of speculative risk? How do we separate genuine re-rating from market euphoria?
That's a critical distinction. Yeah. And you're right to raise the question of speculative risk, especially when current results miss. The key here, I think, and what the market seems to be betting on, is the tangibility of that future vision.
Tangibility, how so?
It's not just a promise. It's backed by those multi-billion-dollar contracts, like with OpenAI, and that astronomical RPO figure.
At $455 billion.
Right. For a company like Oracle, transitioning to cloud, becoming an AI provider, RPO isn't just future revenue. It's a powerful proxy for customer stickiness, long-term commitment, the predictability of future growth.
So it de-risks the future somewhat.
It tells us Oracle has secured multi-year, often multi-decade commitments. It de-risks a substantial portion of future revenue streams. It's this blend of stability from locked-in contracts and the hyper-growth potential from AI. That's what investors are valuing, almost like a high-growth bond.
Mitigates some risk, but still reflects a lot of optimism about execution.
Definitely. Execution is key. And this validation, this re-rating of Oracle, it had significant ripple effects across the whole AI supply chain.
We saw that in other stocks.
Yeah, boosted shares of foundational semiconductor company. NVIDIA climbed 3.85%. Broadcom rose a remarkable 8.86%.
The picks and shovels plays.
Exactly. NVIDIA, dominant in AI GPUs. Broadcom, providing high-speed networking, custom chips for data centers, they're critical.
So investors bet Oracle's big spending plans would flow directly to them.
Clearly, Oracle's projected $35 billion in CapEx for AI data centers. That translates directly into a surge of orders for these key partners. It confirms their integral role in the AI gold rush. Ultimately, Oracle's story isn't just about one stock's historic day. It's a clear, unmistakable signal.
Where the market's conviction truly lies.
In the foundational build-out of AI infrastructure. For you, the listener, it illustrates the immense power of a compelling future narrative, especially when backed by massive contracts, aggressive forecasts, third-party validation.
Even when it means looking past minor current earnings misses.
The future potential, quantified and validated, that's what captivated the market, drove an unprecedented reevaluation.
Absolutely. Testament to the power of a clear, executable vision. But remember, this deep dive is a day of divergence. Oracle shows the reward side of this conviction market. To truly understand the unforgiving nature of September 10th, we have to look at the punishment side. Because for every company riding the AI wave or a specific catalyst to highs, there were others caught in a brutal downdraft, proving that even a strong macro tailwind offers little tolerance for disappointment. So beyond Oracle's huge shadow, let's briefly touch on some other high flyers today. Companies that saw remarkable gains, but driven by distinct catalysts, further showing that market selectivity. The day's top percentage gainer actually wasn't AI. It was Vimeo, Inc., VMEO.
Vimeo, what happened there?
Surged an incredible 60.37%, closed at $7.73. This was entirely event-driven, an acquisition.
Ah, M&A.
Yeah. Vimeo, the video software platform, announced it's being acquired by Bending Spoons, a European tech company.
Bending Spoons, they've been growing fast.
All-cash offer, $1.38 billion total, $7.85 per share. That's a massive 91% premium to its recent average price.
91% premium. Okay, that explains the jump.
Classic M&A arbitrage play. Certainty of a cash offer, huge premium. Stock ignites.
Shows how a clear, immediate value proposition drives gains. Totally separate from the macro or AI narratives.
Exactly. Underscores the diverse drivers of conviction. For Bending Spoons, it's a strategic move, expanding their software portfolio. And then, as we just touched on, in Oracle's wake, NVIDIA, NVDA, and Broadcom, AVGO.
Right. NVIDIA up 3.85%, Broadcom up 8.86%.
Their catalysts were directly tied to that positive contagion from Oracle, the AI forecast, the CapEx plans.
As key suppliers for AI infrastructure, GPUs, networking, custom silicon, they were seen as immediate beneficiaries of Oracle's data center build-out.
A clear endorsement of that picks and shovels thesis in the AI gold rush.
And these varied gains, Vimeo's acquisition premium, NVIDIA and Broadcom's thematic tailwind, it really reinforces the idea. Clear, powerful, understandable catalysts get handsomely rewarded in this market.
Whether it's a concrete M&A offer or direct exposure to the dominant AI theme.
Investors are ready to deploy capital where the story's clear, conviction is strong, and the future potential seems immense and executable.
Really underlines that highly selective capital allocation we saw. That's a perfect lead-in to the other side of the coin, the severe casualties. Because for every major gainer, there was a significant loser, really hammering home that little tolerance for disappointment theme. Let's start with what our sources called the day's cautionary tale. Synopsis, Inc., SNPS.
Synopsis. Ouch, that was a rough one.
Plummeted an astonishing 35.72%. 35%, on track for its largest single-day percentage drop ever. The collapse of Synopsys, a big player in EDI software and semiconductor IP, was a direct result of a truly disastrous fiscal Q3 earnings report.
They missed estimates pretty badly, didn't they?
On both revenue and EPS. Revenue $1.74 versus $1.77 expected. Adjusted EPS $3.39 versus maybe $3.80 expected.
But the real killer was the guidance, wasn't it?
Oh yeah. Compounding the miss was deeply pessimistic forward guidance. They slashed full-year adjusted EPS guidance drastically.
Right.
$12.76, $12.80 range.
Versus a prior consensus around $15.13. That's a huge cut.
Market reacted violently. Billions wiped out.
This really raises an important question for investors, doesn't it? How do you assess company-specific risks versus broad market trends, especially in semiconductors?
So what went wrong for Synopsys? What did analysts point to?
A perfect storm of negative factors, it seems, converged to create this collapse. First, persistent, unexpected weakness in their high-margin IP division. Intellectual property. Crucial, profitable part of the business just wasn't performing.
That signals a fundamental problem.
Second, significant business disruption from the ongoing U.S. export restrictions on China's semiconductor industry.
Geopolitical risk biting hard.
Absolutely. Highlights that ever-present, growing risk for tech companies dealing with sensitive tech. It's like playing chess on a board where rules change mid-game.
And third,
the unexpected loss of orders from a key customer, Intel, after Intel's own reorganization and strategic shifts. So you see, Synopsys is truly the mirror image of Oracle's success.
powerful demonstration that tech isn't monolithic.
Not at all. While Oracle benefited from that clear, validated AI narrative, Synopsys got caught in this brutal mix of internal execution failures, customer headwinds, and macro geopolitical risks.
That combination can be catastrophic.
And the market's conviction mode, it applies equally to punishing disappointment swiftly and severely, as much as it rewards future growth.
Brutal reminder. Even in a record-setting market, fundamental weakness, execution missteps, external pressures can lead to massive, immediate losses.
Underscores the absolute necessity of deep fundamental due diligence, especially in complex, high-stakes sectors.
Crucial point. Synopsys shows those immediate, painful consequences. And then, in a more perplexing development, underlining those elevated market expectations, we saw online pet supplier Chewy, Inc., CHWY, fall 16.59%. Another notable loser.
Chewy. That one seemed odd, didn't it? Because their results weren't actually bad.
Exactly, that's the paradox. The decline came after they reported Q2 results that largely met or even slightly exceeded Wall Street expectations. Adjusted EPS $0.338, right in line. Revenue $3.01 topped the $3.08 forecast.
Even operational metrics like active customers and net sales per active customer were ahead.
Yes, came in ahead of estimates. So what happened there? Why the severe sell-off when, by traditional measures, they met or slightly beat?
It really suggests a market environment with just exceptionally high, maybe unrealistic expectations, particularly for growth-oriented consumer stocks.
Market wasn't just looking for good enough or in line. It demanded something spectacular.
Exactly. The sell-off, despite the okay results, signals investors were likely positioned for a more substantial beat and raise.
Meaning they expected Chewy to significantly exceed estimates and issue much higher forward guidance.
Right. And when that spectacular outperformance didn't materialize, it was met with palpable disappointment, aggressive selling.
Does it also suggest underlying concerns?
Could be. Concerns about the durability of consumer spending in a potentially slowing economy, or maybe about Chewy's long-term growth trajectory in a competitive e-commerce space. In this environment, anything less than overwhelmingly positive, anything that doesn't scream future exponential growth,
Gets met with swift and unforgiving punishment.
another stark illustration of the unforgiving nature of a conviction market, where only the most compelling, rapidly expanding narratives get rewarded.
These examples, Synopsys's clear woes, Chewy's paradoxical sell-off, they really underline a critical lesson for you, the listener. Even what looks like good news can be severely punished if it doesn't meet elevated, almost irrational expectations. And company-specific failures, especially with geopolitical overlays, can be absolutely brutal. Catastrophic losses in a single day.
Shows the profound importance of deep, fundamental analysis. Not just skimming headlines or relying on macro tailwinds, the details matter more than ever.
So, as we bring the day's key themes together, it's abundantly clear. September 10th, 2025 will be remembered as a day of profound divergence. A market driven by that interplay between a dovish macro catalyst, the PPI drop hinting at a Fed pivot, and starkly different micro-realities in individual companies.
The BPI data provided a supportive backdrop, probably prevented a broader decline.
But it definitely fueled a conviction market, not an indiscriminate, broad rally lifting all stocks. So what does this all mean for you, the informed investor, moving forward?
Well, for you, our listener, the key takeaways from this incredibly insightful day are multifaceted and crucial for navigating this market. First, Oracle's surge. It cements AI infrastructure build-out as the market's single most potent thematic driver. Shows investors will overlook current misses for compelling, validated, quantified long-term AI potential.
Okay, takeaway one, AI conviction is king.
Second, Synopsis's collapse. A critical reminder. Tech is not monolithic. Deep-seated operational risks, geopolitical issues, execution failures lead to severe losses.
Takeaway two, company specifics and risks are paramount.
And third, Chewy's paradoxical sell-off highlights incredibly elevated investor expectations. Anything less than spectacular, anything not promising explosive growth gets punished.
Takeaway three, this market demands perfection. Little patience for anything else.
Absolutely. Looking ahead, this complex landscape means the market's path will continue to be shaped by a few key factors, things demanding your close attention. First, all eyes remain firmly on the Fed and future inflation data.
That PPI report set such a clear, dovish tone.
So the upcoming FOMC meeting will be intensely scrutinized. Will they confirm that rate cut?
And even sooner, tomorrow's Consumer Price Index, the CPI report. Absolutely crucial.
Does it mirror the disinflationary trend or complicate the Fed's decision?
Big implications either way.
A second factor.
The barbell nature of the market means the upcoming earnings season faces extraordinary scrutiny, intense analysis.
Investors aren't just looking for strong results.
They're demanding exceptionally positive forward guidance, especially from growth companies.
So expect continued high volatility at the single stock level.
Absolutely. Environment ripe for more dramatic swings like today, as companies either meet those sky-high expectations or fall short.
So success isn't about betting on the market as a whole. Not in this landscape. It's about meticulously identifying specific companies, specific themes that command the highest conviction, while rigorously avoiding those that fail to measure up.
Thank you for joining us for this deep dive into the market's recent movements. A truly pivotal September 10th, 2025. We hope this exploration has helped you understand the market's highly selective, often unforgiving nature, and that intense, transformative focus on the AI revolution that continues to reshape industries and portfolios.
And maybe a final thought to consider. Given the market's clear preference for future growth narratives like AI and its harsh, immediate punishment for current missteps, what does this tell us about the sustainability of valuations for companies without a strong, forward-looking story? Especially if the broader economic slowdown deepens, and maybe the easy money era truly comes to an end. It's something to ponder as you look at your own portfolio and investment strategies.
Indeed. A very provocative thought. Until next time, keep digging, keep learning, and keep those insights flowing. Look forward to having you back for our next deep dive.